Hello friends, welcome to my channel. In this video you will learn about equity linked saving schemes, what are the tax implications and what are the tax benefits that you can get when you invest in these schemes. Okay, so first let's understand what is equity linked saving scheme. As the name suggests, it is equity linked, so it means maximum exposure is towards equity or equity oriented securities. Okay, so maximum exposure is towards equity, but there can be some portion and or part of corpus that also invested in debt instrument just to reduce the risk to some extent, but maximum exposure is towards equity only. And one of the biggest attraction of equity linked saving scheme is the tax benefit you can get under section 80C of the Income Tax Act. Otherwise it is just like other diversified equity mutual fund. So the only difference is you can get tax benefit under section 80C. So for those who don't know what is section 80C, under section 80C you can get deduction up to 1.5 lakh. For example, if you are earning 7 lakh per annum and you have invested 1.5 lakh in ELSS, then you can get deduction up to 1.5 lakh. Then your net taxable total income will be 5.5 lakh only. And there is a list of investments under section 80C that you can invest for getting this deduction. Okay, but this is the total limit. Suppose if you have invested in public provident fund 1 lakh and in ELSS 1 lakh, so the maximum benefit you can get only 1.5 lakh in total. So let's understand how we can take deductions and save tax. So let's understand by taking few examples. So he is Mr. Raju and he has following incomes: income from salary 3 lakh, income from house property 1 lakh, income from business 10 lakh, and his gross total income will be 14 lakhs, right? Gross total income means before deductions. And he has invested 1.5 lakh in ELSS. So he will get deduction up to 1.5 lakh, and even if he has invested 2 lakh, then also he will get only deduction up to 1.5 lakh because the maximum benefit you can get of 1.5 lakh. So net taxable total income will be 12 lakh 50,000 and total tax payable will be 1 lakh 87,500. I'm assuming you know the tax slab rates 5%, 20%, 30%, right? So by that if you compute, total tax payable will be 1 lakh 87,500 before health and education cess. I am not taking health and education cess in this example. Okay, so now let's take example of other person who has not invested in these schemes. So he is Mr. Shyam. He has following income from salary 3 lakh, income from house property 1 lakh, income from business 10 lakh, and his gross total income will be 14 lakhs, right? But he has not invested in ELSS, so there is no deduction under 80C. So his net taxable total income will be same as gross total income, that is 14 lakhs. So total tax payable by Shyam will be 2,32,500 before health and education cess. Okay, so you can see the difference between tax payable in both. So tax payable by Mr. Raju is 1,87,500 and by Shyam 2,32,500. So there is a difference of 45,000. So you can save 45,000 by investing in ELSS, and this is an investment. You can get return in form of dividend, in form of capital appreciation. So it is total savings of 45,000 and plus 4% health and education cess, that is also payable by these two. So you will get total benefit of 46,800. Okay, and there are many mutual fund companies or financial websites that sell their products by advertising. You can get tax benefit up to 46,800. This is because this is the maximum benefit you can get, and this benefit by Mr. Raju is only because he is falling under 30% tax bracket. For a person who is falling under 20% tax bracket or 5% tax bracket, there is not that much saving. You can get tax savings of 30,000 if you are falling under 20% tax bracket, and 10,000 or 8,000 maybe if you are falling under 5% tax bracket. So there is a difference. Now let's try to understand what are the tax implications on ELSS returns. For example, if you are getting dividend, then dividends will be taxable as per slab rate. If you are falling under 30% tax slab, then 30% will be applicable on additional whatever dividend you get. You just have to add that dividend in gross total income, income from other sources, right? So there is no special rate in case of dividends, but there is a special rate in case of capital gains on ELSS fund, that is 10%. After exemption of 1 lakh, you will get exemption of 1 lakh on excess capital gain. It will be taxed as 10% only in case of long term capital gain, but In case of ELSS fund, only long-term capital gain tax will be applicable because there is a lock-in period of 3 years. So 3 years lock-in period, it means it is a long-term capital asset, and 10% will be applicable after exemption of 1 lakh. So let's take an example. Income from salary is 3 lakh, income from house property 1 lakh, income from business 10 lakh, and income from capital gains on ELSS funds will be 3 lakh. Okay, just example. So 1 lakh will be exempt, and excess over 1 lakh means for 2 lakhs there is a tax of 10%. Okay, there is a special rate 10%, and gross total income will be 17 lakhs. So we can't apply tax slab rates on 17 lakhs directly because there is a special rate on this. For 3 lakhs there is a special rate, so we cannot apply slab rates in 17 lakhs, right? So we have to bifurcate this 17 lakhs into two parts. One, those incomes on which special tax will be applicable. So there is a 3 lakh because there is a special tax rate given in law, and other incomes on which slab rates will be applicable, that 5%, 20%, 30%. So we have to bifurcate this gross total income in two parts. So on 3 lakh we will treat this as a capital gain, right? And 1 lakh will be exempt because it is LTCG, and 10% will be applicable on excess of 1 lakh. So on 2 lakh there is a tax of 10%, so it is given in this. Okay, so 3 lakh minus 1 lakh, that is exempt, and 10% will be applicable on excess over 1 lakh. So 20,000 tax will be applicable on this capital gain. And for other 14 lakhs, if we have invested in other schemes like provident fund or LIC premium, so we will get deduction of 1.5 lakh, and net taxable total income will be 12 lakh 50,000. So tax rates will be applicable as per slab rate on this income. So total tax payable will be by adding 20,000 and 1,87,500, so it is 2,75,000. It is the total tax payable by the assessee, and plus we have to add health and education cess, that is 4%. Now if you have knowledge of CAGR, that is compounded annual growth rate, then I can explain few more things. For example, investor A has invested 1 lakh in equity fund. He will not get deduction because it is equity fund. And investor B has invested 1 lakh in ELSS fund, so he will get deduction of 1 lakh. And profit over 3 years is 75,000, and total returns over 3 years will be 75%. So CAGR returns will be 20.60%. But after considering the benefits of ATC, the effective investment of investor B is 70,000 only, because there is the benefit of section ATC. How much? 30,000, because I am assuming that he is falling under 30% tax slab, and the deduction of 1 lakh from his total income and tax benefit will be 30,000, that is 1 lakh into 30%. So his effective investment will be 70,000 only. Okay, because he is getting tax savings of 30%. So effective investment of investor A is 1 lakh, effective investment of investor B is only 70,000. So that's why CAGR returns will increase. Okay, so 35.80 will be the effective CAGR returns for investor B, and on the contrary investor A 20.60%. So you can see the difference between returns due to section ATC benefits.